currently we are seeing a disturbing phase in the IT sector. Would that be a sign for you in terms of that, okay, do you need to enter that sector?
So since you given the name of IT sector, today IT sector has reached a value stage, at least to some extent. The data points don't point to it. Can it be a case of contra investing? Yes, definitely. But value investing may take its own course of time. Because when you run the history of IT sector over the last.
How do you avoid getting trapped in a sector where the narrative may look very good, the underlying may not be?
So there are certain characteristics. First of all, when the narrative starts looking very, very good, it becomes a very unanimous call. You are not the only one. Second thing is that those companies suddenly start.
What factors do you look at that whether it is actually a value or is it actually a value trap?
So there is a very thin demarcating line between value and a value trap. The first question arises that what appears value to me is available or is being seen.
According to you, which sectors from a long-term perspective hold promise for you?
From a long-term perspective, I would invest in companies, especially in.
Hello and welcome to Ventura Spotlight, where we bring you conversations with experts shaping the way India invests. In this episode, we are pleased to have with us Mr. Vishal Jajoo, Fund Manager, Equity at Mahindra Manulife Mutual Fund. Vishal, apart from being a chartered accountant, also holds an MBA in investments and a PGDM in finance. He brings over 19 years experience across equity research and portfolio management. At Mahindra Manulife, he currently manages the multi-cap, small cap, BFSI, value and business cycle fund with a combined AUM of over rupees 13,000 crores. So let's get started. Hi, Vishal, and first of all, thank you for making time for this Ventura Spotlight on this show today. So, before we begin, I've seen your journey, and you have been into equity research, wealth management, fund management. So, can you share, how your entire thing is, how the journey has shaped from research to fund management?
So one commonality is that whether it is research, whether it is fund management, and entire this journey, basically the core research is something that never goes away. So it's like that every part of your career, the equity research of the fundamental part always sticks to you. However, what differentiates is the weightage. Maybe as a research analyst, I would have it spent two-thirds of my time focusing on fundamentals, EPS, the forward P, ROE, ROC, and given one-third weightage to the factors outside it, like the macros. Today, when I assume the role of a fund manager, it is the reverse, wherein one-third weightage is given to the EPS, the forward P, the projections, ROE, ROC, but two-thirds of the impact on a stock in today's environment is basically because of factors which are outside the numbers of a particular company.
Mm. Interesting. Okay. So, you also manage the value fund, and I just wanted to basically take up on that little bit. Uh, we've had like Benjamin Graham, who was considered the father of value investing. Warren Buffett following his style, and but with now you have many new age companies which are coming in, which are the platform companies, and where they have completely different metrics. So how do you see that the value as an investing? How do you think it has shaped up in the last decade or so now?
So if I take liberty of extend its duration till the year 99 2000, so if you remember those terms like ICE, information, communication, entertainment, or TMT for that matter,
Correct.
Teleco, media and technology, those were the prevalent terms used in 99 2000. And during those period of times, you had several case studies where companies were evaluated on the basis of market cap to visitation on those sites, or market cap to the number of eyeballs for a particular website or a company. So those were the times. Today also the new age companies have come up, but maybe the avatar has changed, wherein you have different set of metrics that in certain cases the companies are getting valued at market cap to the total addressable market of that particular opportunity, because there is no point that these are majority of them loss making companies or basically venture capital backed companies, and they would have it burned thousands of crores till the time they approach the IPO scenario. So therefore that scenario still persists. What it was during those days is still there during the present scenario as we speak.
Okay, an interesting example you have given. Okay, so how do you, personally look at, like if you have to look at a value company, right? And do you believe in the value investing as a philosophy personally? And how do you identify yourself as a fund manager?
Value is ascribed to several aspects. See, today value investing, if you were to change with changing times, if a particular script was trading at 60 PE a year ago, but now it is trading at 30 PE over a period of time because of various circumstances. But now if the outlook is expected to improve, then even 30 PE in isolation appears higher, but it is lower than what was the historical dynamics, and that becomes value. Value also comes from the fact that a particular stock basically used to put at 8,000 rupees, but now at 4.5, 5,000 rupees because of certain external issues which are beyond the control of the company. But now, if the times have come up and if the company is resurrecting very well and is expected to do well going forward, then again it's a case of value investing. And the third one is a traditional cases wherein value lies in the form of an inherent asset value. It could be in the form of net worth, it could be in the form of some asset which is not contributed right now. It sits in the balance sheet but is expected to contribute to the profitability of the company in the coming years. So these kind of scenarios one should look at when you want to protect your downside and make your risk reward more favorable.
Okay. So, how would one, because uh, it's like, value and growth has always been a very, very thin line in terms of, where somebody sees value in a stock. It could be a growth potential, but at the end of the day, he sees value. Now, at times, it is also that, are you getting, sometimes something appears to be very cheap. No? So, what factors do you look at that, whether it is actually a value or is it actually a value trap?
So there is a very thin demarcating line between value and a value trap. The first question arises that what appears value to me is available or is being seen by all the market participants. Now, what is it that is there that this company has always been trading at a lower valuation? Because that is the first question that arises, that why the market is not giving it the value that it deserves or the share price appreciation that it commands. Is it something that is there in the external business environment that is impacting the performance of the company? Is it something related to policy related decision? Example, few years ago, coal based power generation companies or cigarette companies were under the garb of ESG, and they never got the right valuation metrics. The moment the ESG criteria got a bit liberalized, investors didn't give them the right thing, then over a period of time, whether the coal based power generation companies or cigarette companies, the true unlocking in the value happens. However, as I said earlier, the thin demarcating line exists between a value and a value trap. So there, for 8, 9 years, it happened that stock of a cigarette company traded at a particular price. In fact, the dividend yield of that company was higher than what a savings bank deposit would have offered. So in that case, 90% weightage should have gone to fundamentals, 10% to technicals, because the moment the breakout came with good amount of volumes, and it was expected that after 9 years, from 2013 to 2022, after 9 years that breakout had come, so that means it was expected to generate disproportionate profit for its investors. And after that, we saw that over the next 2 years, that is from 2022 to 2024, the stock price doubled.
Yeah, so actually, the value investing actually really tests your patience, right? I know we have seen many such stocks and many such examples will always be there. And uh, now, as an individual investor, it is very easy if I have bought a stock as a value stock and it may not perform from 3 years, 4 years, 5 years. I don't have to justify my performance to anybody, but you have a very difficult role to play, specifically in the fund management, where everybody is, constantly looking at that, whether the fund manager is generating alpha, is getting return. So at that point of time, how do you look up yourself as a fund manager, being as an investor, in this type of a particular situation?
So apart from the core value fund, since I also manage small cap and multi cap funds, in those particular schemes, the weightage of value stocks has to be kept relatively low. That is the only way you can manage the short term targets or short term challenges with regard to the alpha that you generate, because there is a very strong case that you are the lone one in that particular category who has invested in value stock. You never know the time frame during which that value unlocking would happen, and therefore that time has to be kept out, and the balanced proportion of your holdings which are invested into growth stocks, that should take care of the investment or the so-called underperformance. If I were to use that term, the underperformance is taken care by the other stocks. So a classic example could be textile companies for that matter. That particular category got severely impacted in calendar year 25 because of tariffs. Textile sector has got high exposure to the export market, predominantly to the US, that suffered very badly. But the moment you have the tariff issues actually unfolding over the last 2-3 months, the way the yarn industry or way the export oriented textile companies are coming up, that has more than compensated for the underperformance that this particular sector suffered in calendar year 25.
Okay. You also handle the business cycle fund, right? So in terms of how do you identify that the cycles, in terms of, so if you could throw some light on that, okay, now this sector is going to be a turnaround, and this is a business cycle which is going to do well. So how do you go about doing that?
So if we split the scenario into various pieces, one change that has happened in last couple of decades is that the cycles have become shorter. So you need to enter first. Otherwise, a significant portion of returns are lost if you are little bit late. So the first thing, if I were to split it into several pieces, is the macro environment. The macro environment has to be conducive enough for you to make a case that you invest in that sector. I'll take an example of microfinance sector, a sector which is by far very much prone to be cyclical in nature. Last year, as soon as the new RBI governor took charge, he started reducing interest rates significantly. Till now, we have witnessed about 125 basis of repo rate reduction and 100 basis point of CRR rate reduction. So that was the first key, that the macros were supporting you. Second, whatever negatives were there, they had actually been behind the particular sector. That is, issues with regard to collection efficiency in Karnataka, issues with regard to collection efficiency in Tamil Nadu, those kind of concerns were receding. Third, key data point were in this, because each company, each sector has 2 or 3 critical moving parts or data points. So here collection efficiency in this particular sector was a data point which started improving meaningfully, and even the state of Karnataka also started reporting good amount of collection efficiency. Gradually, one by one, each of those companies started reporting good set of results. Then the management commentary came that the growth outlook or the disbursement outlook, because when would a MFI start disbursing loan? The moment he sees confidence that this money is going to come back. So third point is the management outlook should be improving. And fourth and final point would be that the sell side analysts gradually start upgrading the report. So by then you are actually in the mid cycle.
So yeah, you mentioned that you have to get in early in terms of the business cycle, right? So for a particular sector, I mean, you mentioned about the microfinance, so if you have to look at some of the more general, or as a more macro view, how would you identify a particular sector? Like currently, we are seeing a disturbing phase in the IT sector in terms of that, it's going to a downturn. Now, would that be a sign for you in terms of that, okay, do you need to enter that sector? I'm just using it as a just arbitrary, example. So, How do you identify the sectors per se?
So since you given the name of IT sector, today IT sector has reached a value stage, at least to some extent. The data points don't point to it. Can it be a case of contra investing? Yes, definitely. But value investing may take its own course of time. Because when you run the history of IT sector over the last 2 decades, from 2003 to 2007 upcycle, wherein if you recall, the flavor was real estate, power, capital goods, infrastructure, and IT had lost flavor. A similar scenario happened in 2030 to 70, and post COVID, suddenly IT companies got attention with work from home coming becoming a new norm not only in India, across the world. So one such event comes up which acts as a catalyst and the companies bounce back. As of now, we haven't seen any such indicator, at least for this particular sector. The free cash flow yield, the dividend yield of this sector has become attractive enough. But in that case, does it propel me to make an overweight position? Answer is no. But would keep on watching for any such data points that something happens that any of these managements or any of these commentaries. Because one differentiating factor in IT is that this is the first sector in its history that has got into the habit of giving a guidance. This was never been the norm by any other sector historically. So we will observe data points or the narrative from the management wherein any of these managements sound out and call out that the worst is behind and they have overcome the issues with regard to our AI related disruption. Also, when it comes, this is the Indian listed companies. Also, globally, the developments need to be monitored that whether the whole AI related theme, if it shows first signs of crack, then that makes a strong and compelling case for Indian IT.
Yeah. And how do you avoid getting trapped in a sector where sometimes the narrative may look very good, hmm? That everything looks very good, but the underlying may not be. So how do you identify those sectors?
So there are certain characteristics. First of all, when the narrative starts looking very, very good, it becomes a very unanimous call. You are not the only one. Second thing is that those companies suddenly start reporting abnormally high profit margins, abnormally high profitability, and very robust and buoyant outlook. Okay. So in that case, if you have 5 year, 10 year history and go back and check that when in the past this particular sector has reported such kind of high profit margins or such kind of high profitability, this has never been the case because things are so attractive. Forget this sustainability of these kind of profitability margins. But new competitors from outside would come and enter the sector and see to it that these margins are not sustainable. We have seen similar scenario. If I take the example of real estate, so real estate typically moves in cycles of 8 years. 2004 to 2012, 8 years we were in upcycle. Anybody who would have invested into real estate directly or would have bought real estate stock for whichever number of companies, though lesser in number, were listed at that point of time would have admit good amount of returns on their investments. From 2012 to 2020, 8 years of down cycle wherein property prices in India stayed stagnant or did not move up. Post-COVID real estate cycle were in an upturn. And in 2024-25, that means fourth or fifth year in an upcycle, every real estate company, the listed real estate company in India, went ahead and raised money through QIP route. And even today, if one were to go and check back, none of those companies present share prices and the prices at which they did the QIP, there is a significant gap and they are yet to reach those particular levels. So these are some of the characteristics which follow abnormal high margins, very robust outlook. You had all the Times of India and financial papers having more advertisements of real estate developers rather than the real content. You had the fundraising, people queuing up for fundraising and using references to get allotment, and rest is we all.
So and now if we come to the investors, I mean generally investors wait, watch. They see, oh, now the sector has started doing well, and they always enter the cycle later. Like you said that you identify the cycle earlier, and they most of the time land up entering at the maybe fag end of the cycle. Right? So what according to you, from an investor perspective, that what is it that they should look at, and try to avoid getting caught, or because then otherwise they'll get an exit at the next cycle.
Next.
Huh. Right. So how do you, what sort of uh, this advice you can give on that?
Once you know on that this is a cyclical sector, when you talk of real estate, I'm not talking of businesses which are structural or cannot stable compounders. Once you know that you are in cyclical business, then where are we in the cycle? As I was giving the example of real estate, the upsurge started in 2020, but investors were still gung-ho till the year 2024-25. Correct. So A, that gives you a duration at after how many years you are entering into that sector, and to what extent you are late in that particular thing. Secondly, compared to the historical average in terms of price to book value, price to multiple, or in terms of valuation for real estate, the price upon NAV or the price upon pre-sales that you are actually ending up paying for this particular thing. And fourth thing, is it going to be sustainable? It is not today. It's if you take 2007-8, people were queuing up to apply for IPO of Reliance Power in the 2007. There were youngsters who opened their Demat account for the first time to apply for that particular IPO, because one narrative had become that power is the only segment wherein demand is more than supply. And in case of real estate, the narrative comes that house slash land is something wherein the supply is limited, and therefore it is a must have in the portfolios.
Yeah, you also handle the BFSI fund, right? And when we observe across funds, across sectors, right, banks is the most widely held, as a stock, as well as even the sector where the maximum investment has been there. Of late, we are seeing a lot of pressure on the banking stocks per se, and as a sector. So, uh, as a sector, it is very critical for the growth and development of the economy, right? So, how should one view as the banking sector as from an investment framework? How do you look at it from an investment thesis perspective?
So, if I take the BFSI sector and split it into two parts, one is the lending part, which includes the banks and NBFCs. Second is the non-lending part, which includes the savers part, which also has life insurance companies, capital marketplace like asset management companies, brokerages, exchanges, that way. So, one is meant on the BFSI. India being a developing country, in the initial part, if you look at it, if an individual, if I were to plot, the moment a child is born, some gifts come and people buy Kisan Vikas Patra for them. Then eventually, through a Sukanya Samruddhi scheme or through a PPF scheme, investment goes for his or her bank accounts. Third is the thing, immediately post education loan is being taken through any banks or NBFCs. And then if you take the wedding, then he has to purchase a house. Home loan is just taken, which is one of the biggest financial decisions in a person's career, followed by immediately followed by the second one, that is purchasing a car. And then after the age of 45, when an individual is standing on his feet, then he thinks of doing some meaningful investments or savings. So for in that particular aspect, you have all the asset management companies, registrars, exchanges come into picture. So if you were to plot a life cycle of an individual with the various segments in the BFSI segment, as of now, the banks and the lenders have certain issues, because the first criteria when we evaluate banks is the asset quality and return on equity. Today, when any other manufacturing company, the moment they produce and sell the material, the issue is sorted for them. But in case of a bank, the moment a loan is being issued, the question arises with regard to the recovery of that particular loan. So key metrics is the asset quality and return on equity. How are they placed? And third most important criteria is in order to disburse the loan growth, because banks again has become very, very competitive this way. This industry, new players have come up either in the NBFC segment or in the banking segment, and the pressure on the net interest margins, which is being expected going forward. Because when you want to grow aggressively higher than the system, it will again be at the cost of margins, NIMs, and that is exerting some pressure on the outlook of the banking sector to us.
So we have also seen that the credit code has also been reasonably strong. So according to you, what should investors look at doing now in terms of banking as a sector?
Banking is an integral part, and that's why it's got a very respectable beat in Nifty. But when, as the metrics that I had highlighted, when you talk of asset quality, it is stable today. When we talk of return on equity, that is also expected to do really very well. But going forward, when the credit growth is expected to be strong, it is coming at the cost of NIM, and that is something which is an area that may get impacted in current financial year as compared to last financial year, going forward, because that particular segment is expected to witness some kind of a pressure, and that's why we expect the banking stocks per se to relatively underperform as compared to their counterparts in the same category, that is the capital market place.
So, no, Vishal, you have been handling small cap value, multi cap, even sectoral and all that, right? So, I feel you're the best person to answer this question. And we are in a scenario where the nobody knows the geopolitical scenario where it is headed towards. We are going to be seeing maybe a spike in inflation, interest rates, so uncertain environment. Uh, Markets have also corrected to maybe fair or reasonable valuations. Right? So, if you have to look today, which according to you what themes or structure an investor should be looking at for the next say 3 to 5 years time horizon?
From 2011 to 2020, that particular decade was basically predominantly dominated by the consumption thing. And to post COVID, the kind of focus on manufacturing that we are seeing, nobody would have imagined that we would be having more than 2 or 3 facilities of semiconductor chips being manufactured into India. The Tata Airbus project would ever come to India, that's taking place. The outsourcing of Apple phones is being happening into India. So as a theme, manufacturing is something that shows good amount of strength, good amount of visibility, and holds lot of promise for team investors. However, manufacturing is a generic term. It has various sub-segments in it that can be divided into wires and cables, that can be divided into solar powered pumps, a term that Prime Minister used recently, urging farmers to switch to solar powered pumps as compared to the traditional diesel powered pumps. And then most important is the energy security. So the entire power ecosystem, right from a coal-based power generating company to transmission and distribution company to a transformer company, all this entire ecosystem would get benefited, because globally, as you mentioned, that with spike in crude oil prices, people would resort to alternative sources of fuel, especially like coal, wherein India and China have got the advantage, and India is rightly placed to take the benefit of the same. After the Russia-Ukraine war, we had observed a similar scenario playing out, that the gas supply to the European nations was restricted to that particular extent, and therefore European nations took call that to outsource a lot of manufacturing which required gas to dependable countries like India, and a number of those companies witnessed good amount of capex and eventual increase in revenues and profitability, and all those got reflected in the stock prices of those particular companies. Today, post this war, hope it ends soon, we may witness those kind of scenarios. So, lot of companies in India today which manufacture oil and gas pipelines, because now the world has realized that Strait of Hormuz is actually the real choke point. global leaders today are discussing the fact that why not to install thousands of kilometers of 2 or 3 pipelines and see to it that there is uninterrupted gas or uh, uh, crude oil supply from one corner to the other corner. That throws some interesting opportunities for a lot of the oil and gas pipeline companies based out of India.
So, according to you, which sectors, from a long-term perspective, hold promise for you?
From a long-term perspective, I would invest in companies, especially in pharma, but pharma also companies having exposure to CDMO, CRMO space because this particular segment has good amount of pricing power. Overnight, these businesses cannot be built up. You need lot of approvals, a lot of R&D to be done, lot of talent to be actually nurtured, developed, and then you need the approvals from the respective facilities based out of India. So one particular category, and when it comes to health, there is no discussion on pricing. These businesses come up with immense pricing power and it becomes eventually moat for the company. Therefore, the CRMO, CDMO space is something in the pharma that we are positive on from a very long term perspective.
Any other sector which excites you apart from pharma?
Pharma,
Okay. Wow. Very good. Very clear and very crisp view. It's very nice. How do you unwind yourself from all this hectic daily routine?
on a daily basis, morning 4:30 meditation is something that is the time that I am with myself. And given an opportunity to take a break, short or long, I would prefer to go to hinterlands of the country. I mean, India is a very great country on that front that after every 50 kilometers, you see change in consumption, dietary habits, changing dressing pattern, everything. To observe that itself is a great experience.
Is very good. So, we always do a rapid fire. So, we would like to do a rapid fire with you as well. So, one sector that behaves like a topper in school, but disappoints later.
FMCG.
Okay. Which is more dangerous? Confidence after profits or panic after losses?
Modes.
Both. One thing investor overcomplicates unnecessarily.
Thinking or thinking that he is the next Nostradamus and can predict a lot of things. Like predicting whether it is the peak of the markets, predicting whether it is the bottom of the markets, predicting that the new US chief has come or the new Fed chief has come, what would be his thought process? Would he be hawkish or dovish? What would happen? So the real art is to stay put with confidence in the stocks of the sectors of your choice rather than going with too much of daily noise.
Correct. If you had to explain market cycles using pool, what would be the example?
So I correlate with the business cycle uh, thesis, saying that from a health perspective, one should have breakfast like a king, have lunch like a common man, and dinner like a pauper. So similarly, at the time of buying or investing in a particular company, the majority of the shares should be bought in the initial phase and then with reduced quantity at each subsequent level in tranches.
One thing that instantly makes you skeptical about a company story.
Lot of companies or managements these days talk about 50% CAGR growth for the next 2 years, 3 years, 70% CAGR growth for 2 years, 3 years. I wonder that why is this person has come to me? There would be several hundred people ahead of me. If they'd known this story and there would have been reliability in this story, they would have already grabbed it.
He said. uh, one investing lesson that sounds simple but is hardest to follow in reality.
The phrase that be fearful when others are greedy and be greedy when others are fearful. Howsoever people may apply it or keep on reading it, then this has been a known statement to the extent that it has become a cliche. But if you see the investor behavior, immediately post the onset of COVID, April 2020 at 27,000 Sensex, nobody wanted to buy. And in September 2024, people were queuing up with SME IPOs also, and they were that gung ho on to markets.
Tougher skill, stock selection or portfolio construction.
I would say portfolio construction, because stock selection would be one of the three integral elements of portfolio construction. Portfolio construction is like that of RRR. So you need the right script, second, right allocation towards that script, and third is the right timing for which you would be riding that particular script. So portfolio construction is a tougher job.
It's like the movie RRR. So thank you, Vishal. It was pleasure having you on the Ventura Spotlight, and thank you for making time out today.
Pleasure is mutual, sir. Thank you. Thank you for providing this opportunity.
Thanks for tuning in. If you enjoyed this video, hit the like button and subscribe for more content that makes your financial journey smarter with Ventura. Mutual fund investments are subject to market risk. Read all scheme related documents carefully